VGT's 143% crushed SPYG is 119%. But you paid for it with a 27% drawdown versus SPYG's 22% drop. Say VGT's crushing it with 125% returns over 5 years, beating SPYG's 104% by a solid margin. That's dominance. But here's where it gets interesting. SPYG's 104% 5-year return sounds great until you realize it's trailing VGT by 21 points. That gap gets expensive fast. In plain English, VGT's the faster race car here, crossing the finish line ahead in both 3- and 5-year periods. Same technology track, but VGT's speed made all the difference for investors. But here's where it gets interesting. VGT's tech-heavy strategy crushed it over 3 years with a massive 143% return, proving concentrated bets can seriously pay off. Here's where the story takes a turn. SPYG's 119% 3-year gain looks solid until you realize it's trailing VGT by 24 percentage points, still playing catch-up. Let's break this down further. Returns are only half the battle. The real question is how much risk each fund took to get there. SPYG's 0.8 Sharpe ratio means you're getting solid returns without taking on excessive risk. That's the efficiency you want in any portfolio. Now for the real question. VGT's 0.7 Sharpe ratio shows slightly weaker risk-adjusted returns. Higher raw gains, but you're taking on more volatility to get there. In plain English, think of Sharpe ratio as your investment report card. It grades how much return you're getting for every bit of risk you're taking. SPYG earned the better grade this year. Here's where things get revealing. SPYG's Sortino ratio of 1.8 shows strong returns relative to downside risk. You're getting rewarded without facing excessive drops. Now let's put this in perspective. VGT's 1.7 Sortino ratio shows it handles downside risk nearly as well as SPYG. Pretty solid protection when markets drop. In plain English, the Sortino ratio is like storm brewing. It only penalizes the downside, ignoring upward swings. SPYG weathered those storms a bit better, protecting you when markets turned ugly. Here's the thing though, SPYG wins on risk-adjusted returns. Lower volatility means better long-term compounding and you'll actually sleep well at night. Let's take a closer look. SPYG's worst 3-year stretch saw a 22% drop. Painful, sure, but far more manageable than what most growth funds endured. Now here's where it gets tricky. VGT's worst 3-year crash hit 27%, 5 points deeper than SPYG. That's real pain when tech sells off hard. In plain English, maximum drawdown is like riding a roller coaster. VGT's plunge was steeper and more terrifying, while SPYG dropped too, just not as dramatically. Both hurt, but one's scarier. Let's see how this plays out. Both funds bounced back fast, just 77 days to recover from their worst drawdown. That's resilience you can count on. Here's where the story takes a turn. VGT bounced back just as fast as SPYG, 77 days to full recovery, even after that deeper drop. In plain English, here's how you measure resilience. VGT took a harder hit during downturns, but bounced back just as quickly. Think marathon runners. One stumbled worse, yet both crossed the recovery line together. But hold on a second. SPYG's 5-year worst drawdown hit 33%. That's serious prolonged pain, not just a quick dip and recovery story. Let's dig into the details. VGT's worst 5-year stretch saw a 35% drop. Painful, but slightly better than SPYG's 37% decline during downturns. Here's the key takeaway. Quick pause. Which fund do you think comes out on top? SPYG or VGT? Now let's flip the script. SPYG took 504 days to recover from its worst drop. That's a year and a half watching your money climb back. But there's a catch. VGT clawed back faster, just 402 days, beating SPYG's recovery by over 3 months, despite falling harder initially. In plain English, both funds crashed hard. But here's the difference. VGT rebuilt faster after the wreckage. SPYG took significantly longer to repair the damage and get back on its feet. Now let's shift gears and look at SPYG's recent volatility. Sits at 17%, meaning you're looking at relatively calmer moves compared to more aggressive growth funds lately. But here's where it gets interesting. VGT's volatility at 22% means 5 percentage points more daily swings than SPYG. Bigger thrills, but rougher rides ahead. In plain English, VGT's riding some serious chop in this stormy ocean. You're getting tossed around more with those bigger swells. SPYG's still got waves, but they're way gentler on your portfolio. Now let's put this in perspective. At 19% 3-year volatility, SPYG's riding smoother than most growth funds. Less drama, steadier gains over the medium term. Here's where the story takes a turn. VGT's swings are 23% over 3 years. That's 4 points wilder than SPYG, meaning bigger thrills and bigger scares ahead. In plain English, think of volatility as an amplifier knob. VGT cranks it up high, amplifying both your wins and losses. SPYG, it keeps things dialed down, delivering a smoother, less dramatic ride. Here's the thing though, VGT's outperformance isn't free, you're paying for it with wild swings. SPYG plays it safer, trading upside for stability. Now we're getting to the good stuff. Portfolio construction is where the real performance differences actually come from. Let's dig into the details. SPYG's tech exposure is massive at 49%, nearly half the portfolio, though it's not exclusively a tech fund. Here's where things get revealing. VGT's nearly pure tech at 98%. When you buy this, you're basically getting nothing but technology stocks in your portfolio. Now let's put this in perspective. VGT wins on raw returns at 143%, but SPYG's better risk-adjusted performance tells a different story. Lower drawdowns and a 0.8 Sharpe ratio mean you're getting steadier gains without the wild swings. In plain English, think of your portfolio like ordering pizza. VGT's giving you nearly all tech toppings, while SPYG splits it half and half with other sectors. Simple as that. Here's the thing though. SPYG's putting almost 70% of your money into mega caps. The biggest companies completely run this show. Let's take a closer look. VGT spreads your risk better. 52% mega cap means you're not overexposed to just the biggest tech giants here. In plain English, SPYG is like a seesaw, weighted heavily toward mega cap giants, while VGT spreads the load more evenly across bigger and slightly smaller tech firms. Think balanced versus top-heavy concentration here. But that's not the whole picture. VGT's 98% tech focus explains the wild swings. Pure sector bets mean you'll ride every tech boom and crash harder. Let's see how this plays out. SPYG's 0.04% expense ratio is incredibly cheap. Just $4 per 10,000 invested. That's hard to beat for cost-conscious investors. Here's what really matters. VGT's 0.09% fee is double SPYG's cost, but honestly, it's still incredibly cheap for what you're getting here. In plain English, Both these funds cost pennies compared to actively managed funds. We're talking couch change here. SPYG just happens to dig a little less deep into those cushions. But hold on a second. That tiny 0.05% fee difference? Over 30 years on $1 million, SPYG saves you about $15,000 in fees. Let's unpack this a bit. SPYG's keeping things steady. 30% turnover means it's swapping out roughly a third of its stocks each year. Here's the key takeaway. VGT barely trades at all. Just 10% turnover means it's buying and holding, not chasing trends every quarter. In plain English, portfolio turnover is like choosing dance partners at a ball. VGT commits to the same stocks almost all year, while SPYG is constantly switching things up, trading more frequently. But there's a catch. VGT's minimal trading means fewer taxable events. That's a huge win if you're holding this in a taxable brokerage account. Let's get into the weeds here. SPYG spreads your money across 217 different growth stocks. That's solid diversification without overdoing it into mediocre companies. Now let's shift gears and look at VGT, spreads across 325 tech stocks, giving you broad exposure while staying laser-focused on just one powerful sector. In plain English, here's the egg basket analogy. VGT spreads across more companies, but they're all tech. SPYG has fewer holdings, but diversifies across different industries. Different strategies, different risk profiles. Let's zoom in on this. VGT's got more stocks, but they're all tech. SPYG's fewer holdings actually spread across multiple sectors. That's real diversification. SPYG's $46 billion in assets means you'll never struggle with liquidity. Plenty of volume for smooth, hassle-free trades anytime. Here's where the story takes a turn. VGT's $115 billion in assets means you're trading with serious liquidity, more than double SPYG's size for tighter spreads. In plain English, think of assets under management like swimming pools. Both are deep enough to dive into safely, but VGT's just happens to be Olympic-sized. Size matters less than you'd think here. Let's take a closer look. VGT's massive size lets it mirror its index almost perfectly, while SPYG's $46 billion delivers equally tight tracking performance. Now for the real question. VGT takes the crown for pure performance, delivering superior returns over 3 and 5 years when growth's your only goal. SPYG delivers what every investor wants, better returns with less drama, avoiding the steep drops that shake you out of positions. Here's where things get revealing. SPYG charges half the fees with lower turnover. That's more money staying in your pocket over the long haul. Now let's put this in perspective. VGT's 98% tech allocation means zero diversification. When the tech sector tanks, you're going down with it. No safety net. But wait, there's more to this story. SPYG keeps half in tech, but balances it out. Healthcare, consumer, and financial stocks ensure you're not betting everything on one sector. Here's the thing, though. Chasing bigger returns? You're signing up for wilder swings and concentrated bets. Want stability? You'll sacrifice some upside. Let's take a closer look. Both funds demand patience. We're talking years, not months. Conservative investors, these aren't for you at all. Now here's where it gets tricky. Your choice comes down to this. Can you handle 35% crashes and 23% volatility? Or do you prefer 22% drawdowns with better diversification? In plain English, VGT's laser-focused on tech. Higher potential, but riskier if that sector stumbles. SPYG diversifies across growth sectors, smoothing the ride. It's the classic egg basket dilemma. concentration versus safety. Let's see how this plays out. So which fund's right for you? VGT, if you're betting big on tech, SPYG, if you want steadier growth across sectors. In plain English, VGT's the steep mountain trail. Faster altitude gain, but you'll feel every bump. SPYG's the gentle switchback path. Takes longer, but you'll actually enjoy the climb up. Now let's connect the dots. Legal stuff. Do your own research, consult professionals, and invest at your own risk. But hold on a second. That's a wrap on our deep dive. Hit subscribe if you want more weekly ETF breakdowns that cut through the noise.